Hedge funds basically invest your money and try to beat the market in every way they can. Sorry, not your money until you're worth $1 million or have an annual income of 200k. These guys make billions per year and manage assets more than the GDPs of small countries. But what strategies do they use, and can you do it without the net worth? The short answer, no. But let me tell you 5 stories that show how the most common strategies work. Number 1, the long short equity. Take Coca-Cola and Tesla. If the manager thinks Coca-Cola is undervalued, he'll invest in the share and expects it to go up in value. He'll then short Tesla because he thinks it's overvalued and expects it to go down. Shorting a stock means making money when it goes down in value. You call your broker, borrow a share of Tesla and sell it for $313. A month later, it goes down to $280. You owe your broker a single share, so you buy it back at $280 and keep the difference. So, the manager makes money when stocks go up or down in value. But then what's the difficult part? It's actually finding stocks that are undervalued or overvalued. And for that, he needs to analyze fundamentals, past patterns, volume, sector news, journals, general market trends, company health, and many more things. Number 2, quantitative or algorithmic funds. These guys get Ph.Ds in physics, statistics, and finance and learn how to translate their knowledge into code that works with years of historical financial data to exploit tiny inefficiencies in the markets. Ever heard of Jim Simons? If not, let me tell you that this guy was a wizard. After working with the NSA to break codes and teaching maths at MIT and Harvard, Simons hired 2 mathematicians to start his magnum opus, the Medallion Fund, in 1988. Quick fact, the fund has accumulated over 100 billion in profits since 88 to 2018. That's a 66% gross and a 39% net annual return. Warren Buffett has averaged 20% over his entire career. Simons, twice the number. And if Simons had continued these returns for the same time Buffett has, he would have hypothetically made, and I'm not making this up, 63 quintillion, 900 quadrillion, 781 trillion, 780 billion, $748,160,000. Number 3, global macro funds. These funds bet on global events and macroeconomic trends. Trends that affect countries, currencies, interest rates, commodities, you get the point. Their goal is to exploit events that rarely happen but end up making a huge impact. George Soros did exactly this in 1992. If you do not know him, a fun fact about him would be his nickname, the man who broke the Bank of England. Back then, the UK fixed their currency to the German Deutsche Mark to keep exchange rates stable, that is, maintain the value of their currency. But the problem was that their economy sucked. Inflation was high, interest rates weren't attractive, and the pound was overvalued relative to the German mark. So Soros' quantum fund borrowed billions of pounds and sold them for the German marks, believing that the UK will be forced to devalue the pound. The UK, desperate to protect the pound, raised their interest rates from 10 to 12% and were even willing to go as high as 15%. The Bank of England authorized spending billions of pounds worth of foreign currency to buy the sterling being sold on the currency markets, but to no effect because traders kept dumping the pounds faster. The UK had to then announce that they were leaving the ERM, which forced them to peg their currency to the marks, and the pound collapsed, earning Soros $1 billion in a single day. Number 4, event-driven funds. In April of 2022, Elon Musk offered to buy Twitter for $44 billion at $54.2 a share. But everybody thought this was a joke because, let's be honest, this is Musk we're talking about. This led to the stock trading in the $39 to $51 range, and this led to event-driven hedge funds like Pentwater Capital, Millennium Management, Hudson Bay, and even Citadel buying up Twitter, hoping that the deal would go through. Fast forward 6 months. Elon finally let that sink in, and Twitter shot up to $53.7. Pentwater spent $725 million in Q2, and by October, the stock was worth more than $1 billion. Others who had invested also made big bucks in just 6 months. But why do they win big when even others around them have the bag? Because they have the patience for stuff like this to happen and the guts to stick their necks out when the rest of us don't. Number 5, multi-strategy funds. In 2008, when Lehman Brothers caused a global financial meltdown, Citadel got caught up in the fire and was losing hundreds of millions of dollars a week. Even then, Ken Griffin prohibited investors from withdrawing their money for 10 months. He was heavily criticized, but he didn't budge even when the firm was leveraged 7 to 1 and lost 55% of its value that year. The result, in 2009, Citadel reported a 62% return. That's recovering half of the losses made in 2008, a time when people lost their jobs and companies were reduced to dust. But how did he manage to pull this off? Multi-strategy funds don't put all of their eggs in one basket. In this scenario, the fund structure allowed Griffin to pivot and cut down on losing strategies, pour money into profitable ones, and stay liquid at a time when everybody was going bankrupt. So, wanna make these big bucks? Cool, get a PhD in math, install a satellite dish on your roof, or get an MBA from Harvard. Let me know what you liked or didn't about the video, follow for more, and don't forget to keep it simple, stupid.